Thank you all for joining us again. We are so excited that Ashley is here. So we're going to do things a little bit different than we've done a couple of the other courses. Ashley is going to do a presentation. It's like on the basic VA stuff. And then when she's finished her presentation, I and Sasha are going to ask some more detailed questions and we're going to do interactive back and forth. We really hope that you guys like this. I have done 5 VA loans. I think I've lost track, and I'm actually working on one right now with Ashley. So we are excited for you to learn all about it. It's one of the best things that have been in our investing career.
All right, guys, so I'm going to go over a quick, just 5 steps to using your VA loan benefits. And the first step that you want to do is to see if you're eligible. So there are a lot of people that aren't sure if they're actually eligible. If you're active duty, you've spent your time in, you know already you are eligible for your VA home loan benefits. But we get people like surviving spouses, the NOAA, reserves, guard, veterans, cadets. So there are an entire list of eligible people. So if you are not sure and you have some military affiliation, reach out to me, reach out to a loan officer, say, hey, can you help me get my certificate of eligibility? Your certificate of eligibility is what's going to be your basically your pass card into the VA world. It is your access card, your golden ticket, so you say. And then once you have that certificate of eligibility, the next step that we're going to do is determine how much entitlement you have to purchase a house. So entitlement is what the VA uses to determine how much of a house you can purchase, what your loan amount is going to be. Entitlement is based on the county loan limits if you're using a second tier, but for your first use, you have no max loan amount. Your entitlement is a percentage, 25% basically of your loan, because that's what the VA guarantees. If that loan were to default, it guarantees their investors are going to get paid 25%. So we're going to determine how much entitlement you have for your home purchase. If you have an active VA loan, I've heard this a lot. I already have a VA loan. I can't get another unless I sell or refinance that into conventional. That's false. We can get you a second loan using what's called bonus tier entitlement. So we would take the county loan limits, and we'll go over that a little bit later, but we'll take the county loan limits, we'll determine how much you have, and you can actually put down a payment too if you are over that amount for the VA bonus tier entitlement. So there are ways to make it work with a second or even a third VA loan all out at the same time. So if you're PCSing to multiple duty stations and you want to utilize that benefit, that is something that you can do. So you want to check for your entitlement is that second part. Third, we want to understand what the VA funding fee is. So this program itself is funded by the VA funding fee. The VA funding fee is a percentage of your loan amount. And if you have a 10% disability rating, you don't pay that at all, period. And if you have a proposed 10% rating, so we get a lot of people who are in the process of getting out of the military or they're med boarding out and they know that they're going to get that rating, but we don't have the actual rating yet. If you have a proposed rating already, we can go ahead and waive that up front. If you are in the process of getting that rating and your loan closes, but your effective date of the disability is before the loan closed, you'll actually get that VA funding fee refunded. The VA funding fee does change sometimes every year. It's anywhere from 1.5% or 1.25% up to 3.3% right now. It varies depending on how much down payment you do. So if you do a 5% down payment or a 10% down payment, that'll actually lower your funding fee. This is not a cost you bring to the table. It is rolled into your loan. The only cost that we can actually roll into the loan, no closing costs, but the funding fee itself. So we want to understand what that funding fee is, how it affects us. If we want to put a down payment and help with lowering that fee, that's the third step we want to go through. And then 4, we're going to actually get pre-approved and we're going to stick to our budget. So this is the most important step. Once we determine, hey, we're eligible, hey, I have enough entitlement to do this, I know what my funding fee is going to be, we're going to actually submit our application with a lender. Going to be a review of your credit report. We do have to run a hard credit pull. We are going to do it. You'll hear people say, hey, that's going to hurt my credit. Running your credit is not what hurts your credit. What hurts your credit is multiple credit pulls. So you go apply for a credit card and then a bank loan and then a mileage card and then a home loan. You apply for multiple forms of credit within a short period of time. Those multiple inquiries, that's what they mean by multiple inquiries hurting your credit. So let your loan officer run your credit, and that way they can determine what you actually qualify for. You're going to submit all your documents. This is the part where we'll be like, hey, do I qualify for this amount? But even if I qualify, do I really want to spend that much? You're going to have that conversation with your loan officer, say, this is my budget. This is where I'd like to keep my monthly payment. A lot of people say I'd like to keep it around BAH or etc. So you're going to go with them and go over all your income that's coming in. BAH, COLA, if you're active duty, if you're not active duty, and say maybe you're getting out and you have a job offer, we can use job offer letters. So all of that income, assets, credit, that's your pre-approval in your budget. That's step 4. And then step 5 is understanding the loan and closing process. So you're going to work with your agent and you're going to get under contract to purchase house. You're going to find your dream house. It's going to be in your budget. You're already going to know what you're approved for. So you're going to have no surprises. You already know that you have been pre-approved and they've looked at your documents. You're going to go under contract. That closing is typically going to take between 3 and 4 weeks to close. However, you can go in a shorter period of time, a minimum of 7 days, or some people want a longer time, about 60 days. Average is about a 30-day close period. During that close period, we will be verifying everything that you said. So if you have that job offer letter or you are working, we're going to confirm that. We're going to call your employer. If you don't have a job and you lied to us, it's going to be bad. So don't do those things. We are going to confirm you have those assets in your account still. We are going to run title on the property, order an appraisal for the property. The VA doesn't have a home inspection. That is on you to get your own home inspection. They do have an appraisal though. The appraiser is looking for minimum property requirements, just like every other loan type. Minimum property requirements just mean it's a safe and habitable home. You can live in it. VA gets a bad rep saying the appraisal process is so hard, we don't qualify for it, that house won't clear. Don't make those assumptions. Don't let your agent talk to your lender, have them reach out to the VA directly if you want them to. There's a whole valuation department they can reach out to. But you'd be very surprised. The VA minimum property requirements are pretty much in line with every loan type property requirements. Nothing extraordinary. Once you go through that process, we review the title, we review appraisal, we confirm all of your income, assets, credit during that we already started during the pre-approval process. We're going to get to closing. You're going to sign at closing, and then your mortgage payment is typically about 30 days after your closing. And that's it. You own a home. Make your mortgage payments on time every month. If you don't pay, you don't stay. But that's basically the 5 steps in the process of going through getting a VA home loan. So hopefully that all made sense and we make it an easy process for you. And then I know you girls had some questions. Let's get into the questions and details about some of the unique nuances of the VA home loan.
So Ashley, you kind of went over who is eligible for a VA loan. And I'm sorry if I missed it, but where can a VA loan be used?
In the United States, in its territories. So we can't use it overseas. If you're getting stationed overseas in like Germany, we can't use it to buy foreign property, but you can use it basically anywhere the US owns. So Puerto Rico, Guam, all 50 states.
And then we are Landlord Help Hub. So, we cater to landlords, but the reason why we think that this, VA loan is very near and dear to my heart as a service member, spouse, and co-owner of Military Landlords Facebook group, but you can only use a VA loan for a primary residence. Like you can't use a VA loan to go get an investment property, correct?
Not correct.
Oh.
So this is the fun part. I always love doing this part because technically you can purchase a multi-unit property and you can live in one side and rent out the other. So you can do that right off the bat, even if you don't have any other rentals, if anything like that. You can also, the VA loan can be attached to a rental property after you have fulfilled your occupancy, which is what a lot of people into that landlord situation that we're going in. You have orders to say, we're going to Maryland. We have orders to Maryland. I intend to occupy that property. That is my intent. I live there for 6 months and my husband comes down and we get command orders. We're off to Japan. I didn't fulfill a year in there. Do I have to sell that or refinance that into conventional? Some people think you do. You don't. I can go ahead and refinance that. The intent is to live in that house as your primary, but if something happens, if life happens, then we can go ahead and you don't have to change that loan. You can keep your VA loan on that property and turn it into an investment property. And I get a lot of people that fulfill their 1 to 3 year duty station tours and then they turn that home into an investment property. And you can do an IRL on that as well, which is the big benefit of keeping your VA loan on there.
Ooh, tell us what that is.
Yeah, absolutely. So an IRL is an interest rate reduction loan, refinance loan. So on an interest rate reduction loan, you have no appraisal. We basically know you can make the payment already. So there's no qualifying for that loan. You have that guarantee. So we just take your interest rate and we lower it. It has to be at least a half a point. You had to have made at least 6 payments and 210 days have had to pass. The VA had to add these regulations because people were churning VA loans. When rates would drop a half to a quarter point, they'd be like, go ahead and refinance again. People would start over their terms and you never really build up equity. So the VA said, we need at least 210 days before you can refinance. However, you don't have to be living in that property. It just needs to have a VA loan on it. So, for example, you were stationed in California and that was 6 years ago, you have PCS, you saw that rates are dropping. You now live over in Florida, but you want to get that dropped rate on your other house. You can go ahead and do that, even though it's now a rental property.
And you get the same rate as if someone was a primary property, right? So that's like the really cool part is that you get that
Correct.
low rate.
Correct. Exactly. So there is no occupancy requirements to fulfill. You've already fulfilled that occupancy when you lived in that house the first time. You get to keep it. It's just a streamlined refinance. It's taking the rate and lowering it. The whole goal is just to save you money.
And this is the only loan that does that, right? So if you were in a primary with a conventional loan and then you move out and you have a conventional loan and you try to refinance it, you don't get to just like keep a personal property like low rate on it. You have to take an investment rate, correct?
On that conventionally, correct. There are other government programs that offer streamlines. However, VA is the only one where it's made it crystal clear if it's now an investment property, it's fine. USDA and FHA, depending on the investor you go to, you're going to run into problems saying, I no longer live there, but give me a streamline. So technically, the other government programs offer it, but none of them has been as clear as the VA of saying, I don't care, it's fine. We know people PCS, you can refinance it.
That's awesome. You know, I love the VA loan. That's how we got one of our properties down to 2.25. It's awesome. So for those right now being, March or January of 2024 with higher interest rates, is this a great bonus project program for those that are getting like 5, 6, 7% rates, depending on the moment it feels like, so that later they can refi it without stress?
I think it's a great time. I'm in the middle of purchasing my own home as well. So I practice what I preach. I think it's a great time to buy. We are in a very unique spot. People who even bought just 30 days ago, too, you're already starting to see some of those rates come down. The prediction, obviously, I don't have a crystal ball. If I did, I'd live on an island sipping Mai Tais all day. But the prediction for the market rate is we are going to see lower rates in 2024. We already reached the max. Probably about the fall timeframe of last year, you were seeing conventional rates hit over 8%. And it was very scary time. House sales slowed down. And going into the holidays was a very unique time for certain buyers too, because we didn't have as much competition. Rates were a little bit higher. They had just lightly started lowering down and people could get a lot of great deals on houses. I think we're still in that little time frame now. And coming in spring, we're going to see that more competitive market heat up. I'm already seeing people who are making offers come up against competitive offers, especially in high density cities like Seattle, San Diego. We are seeing competing offers again, back to that crazy time frame. So I think right now, getting into the houses, building that equity, and then looking into doing a streamline is a great time to do that if purchase period now.
So you were talking a little bit in the beginning about the entitlement and that you mentioned there was this misconception that you can only have or go through the VA loan process once. What is the remaining entitlement and how does that work?
Okay, absolutely. So your first VA loan, the VA has no cap on it. The Blue Water Act in 2019 decided you have no cap. If you can afford and you want to buy a $2 million house using your VA loan, we're not going to require you to have a down payment, which is amazing because all other jumbo loan programs, you're looking at a large down payment typically, at least 15, 25% for a lot of these programs to get any kind of rate that makes sense. So with the first tier, you have no down payment.
Quick
They
question.
also allow you. Yeah.
So first tier, is that like you've never used it before again, or you have no outside loans out currently?
You have no current loans. You have no current VA loans out there. So once you have, and let me touch base on that too, because there is a one-time restoration as well. So if you purchased using your VA home loan and then you have sold that home, we will restore the entitlement and you're back to your first tier use. You have no other loan out there right now. Second tier would be you have a VA loan out there on a house and you're using your second tier. Say you have that house that you bought that VA loan on and you paid it off free and clear, but you didn't sell it. There's a thing called a one-time restoration. We can request restoration. You can only do this once. You will hear people say, well, I've done it more than once. They sneak through the system. There was no way to track it for a few years. They have locked that up within the past 3 years or so. They do track it now. But one-time restoration, you can restore the entitlement on that house that's free and clear, and then you have full entitlement again. So you either need to restore by doing the one-time restoration or by selling that house completely. And then you're back to first tier entitlement. And then the bonus tier entitlement, remaining entitlement, will be based on your county that you buy in. So we would look up the county loan limit. We would see how much entitlement you've used, and we get that based off your certificate eligibility. It is not an exact number. You can't just be like, well, I bought a $500,000 house, I used 500. No, it's a percentage. It's a guaranteed the loan. So we'd pull up and determine exactly how much it was off your certificate of eligibility. We'd type that number in and see based on the county loan limit how much you have left. And I have a little calculator that just does that, and pretty easy peasy. Tells you how much you can do with zero down payment again.
So when you say certificate of eligibility, what is that and where would someone find that? Is that something that the lender provides, or is that something you look up on your own? What is that?
So you can actually get that in your e-benefits website. If you don't have access to e-benefits, any lender can pull this up. We have a login on the VA website where we can type in your social. We'll need your social and your year of birth, and then we'll be able to pull up your certificate of eligibility. There are some cases, like with surviving spouses, or if you were in a long time ago and finding your records, there are some cases we will need a copy of your DD 214 to show, hey, or if you're National Guard or something like that, your NGB 22. So we might need additional supporting documents if it doesn't automatically pop up. But I would say for about 95% of people, it just automatically pops up when we type it in there. That is what the VA says, yes, you're eligible. They check your record basically against your service record, and they say he or she had an honorable discharge, and or they fulfilled the minimum amount of years for reserves, or they're getting DIC as a surviving spouse, or whatever makes them eligible for a VA home loan.
Okay, and can you ever go over your entitlement amount?
For your bonus tier, absolutely. So if you go over your bonus tier entitlement, say, look, you've used this much entitlement on your California house, it was a lot, but if you want to buy in this county, you can buy a $350,000 house. We're putting zero down. You're like, well, I want a $380,000 house. Well, we would calculate the difference between those two amounts, and you only have to put down the 25% guarantee on that difference. So you don't have to put down, say I said you could buy 350 and you want to buy 380, you don't have to put down 30,000. You only have to put down the difference of the guarantee. And that's, again, just a little calculator we type in, and I'll be able to tell you exactly how much down payment you would need. And it gives you your VA home loan on that.
That's awesome. Okay, so you know that this is like a hot topic right now. Can you talk to us about assumables?
Yes, I actually love assumable loans. So you will find a lot of lenders who be like, they're not worth your time, they're not worth your effort, don't worry about it. It's because they want you to refinance or to buy with them because that's how they get paid. I'm a military spouse. I want everybody to get in the best mortgage for them. And it might not be a new mortgage with me or any other lender. It might be an assumable loan. The biggest perk, obviously, of an assumable loan is years ago, we had those 2% and 3% interest rates. That is a great deal. They're also usually a couple years into their mortgage, you assume that term too. So if they have 27 years remaining and a 2.5, you get both of those things. You have a 27-year term and 2.5. Thing is, in those past few years, equity has ballooned for those people. So they might have about $60,000 worth of equity. So we need to find a way to bring those funds to cover that gap. The problem is everybody's like, well, I'll just get a second loan. The VA has made it a little bit difficult because your second lien needs to be assumable as well. The only way to get an assumable second lien is with private money. That means you can go for a bank and get a personal loan out, a non-attached loan that's not attached to a property or anything. I've seen somebody do a credit. It was only like $12,000. They did a credit card line of credit and pulled it out that way. Borrowing funds and doing like a private lien or getting gift funds, one of those two different ways. So we have to come up with that gap money for the equity. There is no available on the secondary market. You will hear a loan officer say, we'll just get a HELOC, and they'll go through the process and they don't understand that second has to be assumable. And there's no product available in the market that offers assumable second, especially up to 100% loan to value. But it's that assumability factor. But the process itself, if you would have asked me a year ago, I would have been like, it's terrible. It's buckle up, buttercup. It takes about a few months. They're going to ask you for everything that's under the sun. They're going to do everything in their power to just say, give up and get a regular new loan with me. But the VA noticed. We went to the VA lenders conference back in 2023 in Kansas City, and we brought this to the head of the VA, and we said, listen, this is a real issue. Our veterans are not being able to assume any of these loans. And they were mad. They were like, this is unacceptable. This is part of their contract. The assumability is a great feature of the VA loan that we like to have. And it's law, it's federal law. The entire VA handbook is written into code, US code, that they have to allow assumability of these loans. And they have to do it within a 45-day period, giving you a decision. This is something no lender has been doing for a while. There was even a lender out there, a servicer, that was saying, oh, we just don't have an assumability department. Too bad. So we reported this to the VA. The VA immediately came out with a circular back in May and said, you need to have a decision within 45 days. It needs to be timely. You can only charge these things, and outlined assumability for these servicers and said, we will punish you if you don't do this. Got a little bit better December, this circular too. And I'll email these circulars. Maybe we could put them in here. But this circular said, you guys really got to do this, or we're going to start pressing charges against you and take away your ability to service VA home loans. So they got a little bit more teeth in the December one. And I've heard people closing in 45 to 60 days on assumable loans now. If you find an assumable loan and that is something that you can go after, or even a Vendy loan, those are great deals to be had right now. So definitely ask. The worst they can say is no, maybe they want a quicker closing. But if you have some funds for the gap or you can find them, great deal out there right now could be had.
I thought I probably should have asked this question in the very, beginning of talking about assumable loans. And I know what an assumable loan is, but could we backtrack just a touch for those who don't know just basically what an assumable loan is? What is that?
Absolutely. So an assumable loan is any government-backed loan. So USDA, FHA, and VA all allow assumability of their loan products. And VA too, it doesn't have to be a veteran that assumes it or somebody with VA entitlement. You can allow anybody to assume a loan. The only thing is your entitlement will remain tied up unless they substitute their entitlement for it. They have to be a veteran to do that. So I've seen it in a case where a father allowed his son, who was not a veteran, to assume that loan. He was fine. He said, I don't need my VA entitlement. Don't worry about it. And they assumed that loan that way. But an assumption allows you to take over that mortgage itself, the entire terms. So the 27-year term, whatever the interest rate is, you take over those you basically just get that entire mortgage, however it's set up. You do need to qualify for it. You'll go with the servicer. No lender or originators can be able to do this. It has to be whoever holds the current loan, but they get to keep all the benefits of that loan. If it's a VA, if it's USDA, FHA, it's an assumable loan again. It keeps that interest rate. It keeps those terms. It keeps everything on there.
Can you use bonus entitlement for it? And how does that work?
So that is a question that was brought up recently. I'm in a VA group. That was a question that was brought up recently. Some back and forth. Supposedly you can, but I have not seen it actually. I've not heard any success stories of it actually happening. So supposedly you can. It would work just the same way as if you were purchasing a house. They would calculate how much entitlement you have, and then they would substitute your entitlement for there. You would just have on your certificate of eligibility, it lists all the loans you have, and it would show however much entitlement you need goes to that one.
And so you wouldn't be able to bring in the 25% difference, right? So like if you don't have enough entitlement, this is not one of those that you can like budget.
No, that was also a story that was brought up recently too. They were like $100 short of VA entitlement and could not substitute. They didn't have enough bonus to your entitlement and they could not substitute. They could not bring in any cash different. Like that was it. You have to have the full entitlement to substitute. I felt really bad. I saw that story posted. I think that wasn't actually maybe real estate. It was in a different group, but it was
awesome. Well, okay. So we've talked about assumables. Let's talk about that house hacking you talked about, like the only type of VA loan that you can make a rental from day one.
yeah. So your multi-unit properties. Usually you need a history of being a landlord to purchase rental properties. The VA allows you to hire a property manager and be a landlord from day one. If you have a history already of property management or having a rental or anything like that, you don't need to hire a property manager. But the VA gives you a caveat and allows you to do that. So you can purchase a multi-unit. And what's amazing, and a lot of people don't get it, you can purchase up to 7 units. And that is two
Yes.
veterans getting together.
Is that new?
No, but it's not very well talked about because it's 2 veterans. So you get you and your battle buddy. 2
Okay.
veterans get together and they use their entitlement. You can get 4 units, a unit for each veteran, and then a business unit. So that is up to 7 units on one property using a VA home loan for 0 down, which is unheard of. If you have just one veteran using their entitlement, you can go up to 4 properties and you can rent out all 3 of those. As long as you live in one of those units, that is your primary residence. And you can rent out all 3 of those and immediately we can qualify you with using the rental income on those properties to purchase the house. I had a veteran in Virginia Beach that bought a 4-unit and he lived in one of the units. He was remodeling one of the units and he rented out 2 right away. We didn't need leases or anything. We used the fair market value. We had a CMA done, a rental schedule done, and we were able to qualify him based on those rental units. So very easy loan process. just a normal VA loan, just a normal day in the life of
You
VA loans.
talked about how you get more entitlement for a 2, a 3, and a 4, which is helpful if someone is trying to like has limited in one market but could have more in another market.
Absolutely. So the more units that you have, it's basically just what you said. So the more units that you have, the higher your tier of entitlement is. So if you're working off a bonus tier entitlement, again, it doesn't matter on that first, but if you're working off bonus tier entitlement and you're like, oh man, the county loan limit's 700 something here, but if I go to a 2 unit, I can get 1 million plus. If I go to a 3 unit, I can get X. If I go to a 4 unit, I can get X. So the higher amount of units, you can get more. And then again, depending on counties, and people are like, well, most of the counties are just the national loan limit. That's not true. You could be right next door. There's a place in Maryland that is one county is this loan limit, this county over here is this loan limit, and this county over here, and they're all within a 30-minute drive of each other. So make sure if you're searching in an area, you're asking, hey, what are the county loan limits on the ones right next to me too? Because you might get more bang for your buck right over the bridge, where staying in this county you might get a little less.
You're
So
not talking about Lusby, are you?
I am.
Yeah, we've had
So
this
much bang for your buck.
because
I still don't understand.
because it's Pax River. Okay, so if anybody's cluing in, let me give the example that she is alluding to because she and I have talked to this a whole lot. So there's Pax River Naval Air Station, which is 2 hours from DC-ish. So if the base, you can go 20 minutes in to St. Mary's, which is the county it's in, or you can go 20 minutes over the bridge. And if you get into Calvert County, you get way more entitlement than if you stay in St. Mary's. So it's the same like distance to work, but you get a whole lot more entitlement because we've had some discussions about that.
Yeah, so there's there's Charles, Calvert, and St. Mary's County, all within a 30-minute drive, which I just don't get how St. Mary's County is still that lower tier of entitlement. And it never makes sense when Fannie and Freddie come out with the loan limits. It never makes sense. The VA is not the one that comes up with these loan limits either. They go off of the Fannie Freddie, the regular county loan limits. So no matter what loan type you're looking at, you're always going to have those loan limits. When we get into FHA and USDA, they're going to also have additional loan limits and things like that, income limits. But for VA, you want to make sure, hey, look at all the counties around you too, because you might be able to get a lot more bang for your buck 20 minutes away.
And then you had talked about if you PCS somewhere and you buy your primary home on a VA loan and you stay there for your term and then you get orders to go somewhere else and you decide to rent the house out instead of selling it, you fulfilled your obligation. Does that same principle apply to multiplexes?
Yep, absolutely. Absolutely. Same thing. Because that's the only difference between that multiplex and the single family is you have people paying part of your mortgage. So as far as the loan qualification wise of it, we need some reserves for those investment properties, but there's really not much of a difference between the two loan programs themselves.
It just
Whereas
seems like
conventional, you're looking at it different.
it just seems like such a great source of financing for service members, especially with such a transient life where you're so unsure of where you're going to be and when you're going to leave and where you're going to go next. And, the likelihood of coming back to where you just left from. So, okay.
So
Yeah, and it's a great house hack.
yeah, it's awesome. I just wanted to jump in one just to confirm because I see the question all the time. And when I send them to this video, I want them to see this. So my mother, brother, sister, cousin found this awesome house in their area. I will never live in it. Can I use my VA loan?
No, unless if you and your spouse are stationed in San Diego and you found this wonderful house in Kansas City, that's where you guys are from, that's where your wife wants to move back to, but you still have 3 more years. Your wife decides, hey, I'm going to go back to Kansas City early. Your family members, they do have to be your immediate dependents, like your spouse or your children. They need to be the ones to occupy, but they can take your occupancy for you. So you can still be stationed in San Diego. They could be like, I'm out. I don't like good tacos. I'm going to go live in Kansas City, and they'll fulfill the occupancy. So that is a workaround if you want to work that way. But we do hit you for both mortgage payments. If you're going to be living or rental or whatever you're living, paying rent in there in San Diego, we're going to hit you for both. So qualify for both.
But that would, I'm just thinking outside of the box. You can tell me this would be allowed or not, but say your service member is going on a year deployment and you want to, you want your family to move closer to home, and that's probably where you're going to retire. So you could use the VA loan to go ahead and buy that house because your family is going to occupy it. And service member is going to be overseas somewhere anyway. Is that a possibility?
Absolutely. Yeah, absolutely. As long as the family member is going to occupy it, that does our occupancy for us. It can't be a parent, though, unfortunately, unless they're an actual caregiver. They file them on the taxes as a dependent, things like that. They'll make sure it's an actual dependent. But if it's your spouse or your adult children that you guys are all moving in and they just need to go now, and we had a girl who she was going to college actually in San Diego, and they were going to follow up like 7 months later, and she went early, she occupied, and they followed up.
Okay.
That's awesome. But that's it. There's no other like you can't just find a rental and use your VA loan and call it a day.
No, we can't do that. Primary homes have to live in a portion of it.
And then so let's go in. I know I saw this question. Say you move in it, you get orders 3 months later, written orders come, you're still golden.
Yeah, go ahead, leave. That's fine.
Story of our lives,
That's fine.
right, Ashley?
That's the story of our lives. Yep. So
Which one?
life happens.
I
I've
lived
seen
that dream.
all, I've seen all kinds of crazy things. Don't go in there with the intent of, well, I'll say I'm living in it, but I know I'm really only going in there for a month and then I'm leaving. I'm only going. I've had somebody be like, oh, I'm going to Pensacola for flight school. I'm going to buy a primary. Well, your orders say that 3 months later you're moving over. So I can prove that you're not going to live there. So don't go in it with the intent, because they do have mortgage fraud investigators. They actually, the servicers and the investors, send out people and take pictures. You check on Indeed for these jobs, they snap pictures and they're like, let's see if somebody's living there. So they will check for mortgage fraud. But if the intent is you move there and then something like happens. I had a lady who got pregnant with twins in DC, and she was like, I don't have room for these kids. I need to buy again. So she bought a new house, as long as it makes sense. So you want to upsize, that's perfect. We want to downsize, something happened. We got orders, we're going to move. As long as it makes sense and we can explain it, then we can go from there.
Perfect.
Put on that light, sorry guys.
Oh, no, you're fine. So let's talk about what we see a lot of that not a lot of people can talk about. And this is why I wanted you. Let's talk about rehabbing and construction.
Okay, so you won't see a lot of this because not every lender has access to these loans. So you want to work with a correspondent or a broker lender who has access. So your retail, your big box lenders, your online ones that are like, hey, we only do VA loans, they don't have access. They're in-house lenders. They don't have that program. So you want to work with somebody who has access to them. Our biggest investor that does that is AFR, and then we would take your loan, we would broker it to them. You do your application with us. We'd set it all up. We'd send it over there. A renovation loan allows you to do repairs. They can't be structural repairs. You can't just strip it down to studs and rebuild the entire thing. And I will pull up the list of repairs while I do that. But there is basically a list, and it tells you, hey, this is how much you can spend on it. And I'm pulling up those guides. And then construction, it is basically for anybody that wants to do a 0 down payment construction loan and not pay interest during the build period. It's not for everybody, because they have different products for construction loans. You can buy a land loan and then do a construction and then refi them all into a regular VA loan once the build's done. The construction loan is a one-time close VA construction. Basically, you put 0 down. You'll have outside closing costs. So you'll have your build plans, you need to pay the builder for. If you need land inspections, you need to pay the inspector for that. So you'll have your outside fees, and then you'll need to negotiate any closing cost help or anything, but it allows 0 down, and your interest payments are basically rolled into the loan. Whereas a construction loan or a land loan, you're paying payments for those 6 to 9 months. So it's the biggest perk of doing a VA construction loan is no down payments and no payments for the interest for that period. Renovation, we're limited to the conforming loan limits for that, so we can't do the $1 million properties. They do have that overlay. The home must be habitable during renovations. That's what I said. We can't strip it down. You're allowed a certain amount of time out of the home to do certain things, that you need to be able to live in it. It can't be that thing's shut down for 6 months. Where are you going to live? So we're not hitting you for any other debt to income. It's a fully amortized fixed rate, 10, 15, 20, 25, 30-year terms. It's a 1 or 2 unit house only. So they do have some overlays to do this. Projects over 200,000 require an inspector to come out and do a second review, project review. You can do repainting, fixture swaps, accessibility upgrades, ramps, rails, attached additions. Only one general contractor may be used. They have to register with the VA. You can't do the renovations yourself. You can't build yourself either on the VA construction loan either. Certain states, so like Texas is the big one. I'm not licensed there, so don't quote me, but Texas has some specific overlays for them too. 100% loan to value, just like any other VA loan. We do have minimum credit scores on those, and that's one thing I didn't touch on yet. VA doesn't have a minimum credit score. So the VA doesn't put any number down. Whoever tells you what a minimum credit score is, that's the investors. There are investors that go all the way down to 500 that I have seen for their credit score, and you'll hear a lot of lenders be like, I need a 620. You'll see most of lenders start at about 580 for your credit score, but there are investors down to 500. So there is no minimum for a VA. It's more about your credit history and what happened in the past versus having a minimum credit score. This program, though, the renovation, it does have a 580 minimum credit score, and you need a compensating factor with that as well. The amount of the repairs is capped at that. Oh no, it just says over the 200, you'll need a second project review. It's a ton of guides. That's why I don't have it memorized. 9 months is the cap on how long it can take. You get 3 draws off of it. And then any unused contingencies, they will require a contingency fund in there, just gets put back to the principal. So those are the basics of that program. Anybody that has more questions about that, I can send them the packet from the investors so they can look at directly and say, all right, this makes sense for me. Let's move forward and see what else. Or, hey, no, this just doesn't, I don't qualify or I don't like it for this reason. But yeah, it's a great program to have.
So what did we miss? What craziness should we be asking you that you've seen that only you can do, or, you know, the like yous can do, that people have questions that we should be asking?
I think that credit score thing is definitely something that I wanted to bring up. No minimum credit score for a VA loan. That lighting is killing me. There we go. Your work history is another one I see. Everyone's like, well, I don't have a job yet. I only have this job offer letter. You can absolutely get a VA loan with just a job offer letter. You started in a new field of work and you don't have a 2-year history. If people come out of the military, especially infantry, they come out and they're like, well, I'm now doing XYZ, but I had a personal trainer that was doing personal training and he works at a gym and he's W-2'd and he has history of running all the PT programs in his brigade the entire time. So he has history. We can usually look back at your military service and connect that job and that history. I can't say, oh, you're a doctor now and you were, a toilet scrubber. So I can't connect those 2 things. But if I can connect the job, you probably have a history. So if you've been told you can't do it for income related issues, that's why. We do need 2 years of bonus and variable income and commissions. Let's see that no credit score, income, assets. You can get gift funds, seller concessions. It's a huge one I see. And I have one more too. But seller concessions, I hear agents be like, the cap is 4%. That's all I can get you on a VA loan. False.
Wait,
They can pay all of your closing.
stop there. What is a seller concession?
The seller concession is the seller is paying your closing costs for you. And I see this on a majority of my VA loans, actually. So the seller, you get a credit from them to pay your closing costs. The VA doesn't have a down payment, but it does have closing costs to the loan itself. Title, appraisal, property taxes, homeowners insurance. Typically, we estimate these to be about 3%, depending on where you're buying in the county. They could range from 2% in some less expensive counties up to 4 to 5% in some more expensive counties. And depending on where your homeowner's insurance is, some states are a lot higher than others. So those are the range. But we ask the seller for a credit to pay those. They can get a credit to pay all of them. So if your closing costs are 5% and you want the seller to pay for all of them, and your agent can negotiate that, you can get all of it. There is not a 4% cap. They can pay 4% in additional closing cost or additional concessions that aren't closing costs. So they can pay for your VA funding fee. They can pay off debt. VA is the only loan program that allows the seller to pay off debt to qualify for the loan. So if you get 3% in seller concession to pay your closing costs, you get another 2% from the seller, and you don't need it for your closing costs, you can use it to pay off debt to help qualify.
How does that work? Can you go into more specific and explain how that works?
Yeah, so we would just ask the seller for 5%, say, your agent would negotiate this with you. So you're asking for 5%, I do your loan estimate, and I say, I only need 3% to cover all these closing costs, but it looks like we have, a credit card here for $1,500. Do you want to pay that off? I can use that seller concession by paying that.
Do you have to get
You
their
can use up. No, your seller concession is for whatever you want to use it for. They don't get to see what you use your seller concession is put on there. So as just a seller concession, we usually do like a chunk of, you get 10 grand,
How high can that go up to?
an additional 4%. That's where that 4% number comes in at.
So if say you're the borrower in a scenario and you make a deal through your agent to buy a property and the seller agrees to pay your closing cost, you can then get an additional 4% on top of that for other things. whatever it is that you need to do within the closing bounds.
So
of that
just to,
property.
so just
Right.
to confirm, so like if your closing costs are 4% and you can get 8% from the closing cost, 4 plus 4 is 8.
If your closing costs are 10%, you can get all 10% covered by as long as all of that is closing costs plus 4%.
And then can you
Everything that is a loan cost.
So can you just
Yeah.
really briefly, I know it's like way too many to list, but could you give our viewers just an idea of when you say closing costs, what on the HUD or Alta or whatever closing document, what are those closing costs that you're specifically referring to? I don't mean to put
Absolutely.
you
So
on the
you're
spot.
No, it's okay. I'm going to bring up the ones that for the 4% too. That way I have a little bit list of the examples they give because it's kind of funny. Like they put a microwave in there and stuff. So I'm going to bring up that list really quickly. Seller concessions. So I'm going to circle back to what closing costs are, but the additional 4% can go towards things like payment of the buyer's VA funding fee, prepayment of the buyer's property taxes and insurance, gifts for such as a television set or a microwave oven, payment of extra points to provide permanent interest rate buy downs. And I do want to touch, I'm circling back to that one too. Provision of escrowed funds to provide temporary interest rate buy downs, payoff of credit balances or judgments on behalf of the borrower. Seller concessions do not include payments of the buyer's closing costs or points appropriate to the market. So you can get all of the points and closing costs normal, less additional stuff. So the temporary buy down, a seller has to pay a temporary buy down. That counts as part of your 4%. But they can pay the temp buy down and closing costs. Closing costs are going to be things like your title fees, your property taxes, your homeowner's insurance, any lender fees that you have, if you choose to buy down the rate with points, your appraisal fee, transfer taxes, city, county taxes, recording fees, owner's title insurance, lender's title insurance. I can tell you've been doing this for a while too, because you said HUD. So we put them on LEs now, loan estimates and closing disclosures. But yeah, anything that is a loan cost, if you have to basically, that is part of some requirement of getting a loan, seller can pay that. It's not counted towards a capital. And there's also one thing I want to mention too, a VA buyer, and this is something that's coming up recently a lot more because of the lawsuits and things that are coming up, but the VA buyer cannot pay any agent fees. So even if you have a buyer's agency agreement with them, you can't pay them a TC fee. You can't pay for their brokerage fee, even if it's $400. You can't pay for their commission. The veteran cannot pay any agent fees. That has to be paid from the seller's side or the seller's agent, the seller's broker, however they want to word that and fix that with a real estate lingo. Not my circus, not my monkeys. But on my loan estimate, no commission, TC, brokerage, transaction fees can be charged to my veteran. Never, ever. So if you have been charged on your loan, on your VA home loan, for any type of agent fees, make sure you reach out and be like, hey, I need this back.
Is there anything else that you think our, viewers would benefit from hearing from your experience? I know we covered a
Your
lot.
time frame. We did a lot. I know everybody's probably like taking a snack break at this point, but I feel like just make sure that you know what you're going into. You might not even know if you want to buy a house right now, or you might be at this duty station. I want to share a little personal thing real quick and then I'll wrap this up. But I grew up in a trailer park in West Virginia. I started out with no money, broke. My husband and I, we rented an apartment in San Diego. He told me I couldn't paint the walls to bring home my twins. And I was like, I want to buy a house. And so we went and looked at houses. This was years ago, where houses you could actually buy in San Diego for a little bit less. And we found a fixer-upper. We used his VA loan home benefits. I was on the loan as well. We borrowed from our TSP. So you can borrow from your TSP as well if you're active duty, and it just goes straight back in there. It's a little tip. Borrowed from our TSP and purchased our first home together. That was over a decade ago. That was a $400,000 house. We put renovations into it. We gained equity out of it within 3 years when we PCS the first time. Put that into another house. We sold that house, gained equity out of it again. Every duty station we have bought at a house and we have gained equity and purchased. We are now purchasing a $700,000 plus house over years of utilizing your VA home loan benefits. It is a tool to help you build wealth. We have used that VA home loan to build rental properties that we now own and manage. This is something that I wouldn't sleep on. Yes, it might not be the perfect time for you to buy, but when else are you going to be stationed somewhere that the military is going to give you BAH, pay for that mortgage for you or a majority of it, and help you build that equity and start building your wealth for you? So just look at it, see if it's something that makes sense to you. I think it's a great tool and benefit that a lot of people just don't understand and then therefore don't utilize.
Definitely. And when should someone reach out to you? You know, you mentioned maybe you're ready now, or maybe you're thinking about it. When in that thought process is it a good idea to reach out to you?
If you're not sure qualifying wise, I would always just reach out right away and just say, hey, do I even qualify for around this number? If you know, hey, I'm probably going to qualify if I've done this once or twice, I would say within about 90 days of your purchase time frame would be at least a good start. But if you are not sure, 6 to 9 months is a fine time frame because that gives us time to work on any of the issues. If you have credit issues or you want to get to a certain determination of, hey, I know that I'll have this much saved up by then and I want to do that. So I would say 6 to 9 months, not any before that, because you're just kind of reestablishing things from there.
So get with your lender in the planning phase, maybe even before going to look at houses, correct?
Always, that is the biggest blooper I see all the time. People are calling an agent, and they're like, can you show me this house? The agent, if it's a newer agent, takes them out to see a house, does not even know if they can. Would you go shopping without your wallet, without a list, without a budget? Call lender first. Call your loan officer and say, hey, I need to know how much I qualify for. Because if you're looking at $700,000 houses and then you realize, oh, I found it, I love it, and your agent and you call up the lender and they're like, okay, that's great, you qualify, but your payment's gonna be this. No, I don't want that. I don't like that. You need to know what you're going into before you fall in love with the house and that you qualify for it. So most of the old school agents know by now, hey, get a pre-approval letter. I'm not going to show your house without it. Call your lender first.
Definitely. And, you know, we're going to pass along your information so people can contact you directly with any kind of VA loan questions or concerns, or so they can, you know, pick your brain and see if you would be a good fit. Can you just share with us a little bit before we go? I know that your company is Leader One, but where can you operate? What states can you operate in?
Leader One's in all 50 states, but my main place of area I work in is Maryland. I'm licensed in a few different states because we've PCS'd. If I'm not licensed in your state, I might be able to get it very easily too. So just reach out to me. But I don't always refer in-house either. I want you to work with somebody who has the best loan product for you. I work with a company too, or not work, but I volunteer with Beta VA. It's a great online resource as well. And I've seen it mentioned in your group a bunch of times too. So join that page as well. I work with a lot of people on different social media groups that I understand that know VA loans. So even if I'm not licensed in your state, I love talking VA loans. So just call me and I'll be like, oh, let's go over your scenario. And then when you find somebody, you'll know what to ask them. So feel free to reach out to me anytime. But
Perfect.
all over, I'm in about a dozen states.
Oh, good. Well, then we'll be sure to share your contact information with our audience and so they can reach out to you. And now they will be better educated, so they will be able to ask all the really good questions.
Yeah, absolutely. I love to help.
Thank you.
Thank you.
Absolutely. Thanks for having me on today, ladies, and have a good one.
All righty.